Welcome to the Deep Dive from Talk Tickers. Today we're digging into the Q3 2025 earnings for a major player in the hospital and behavioral health space.
Yeah, and this one definitely made some waves. Big headline numbers.
Absolutely. So our goal today is to, cut through the noise, figure out what drove that huge beat, what's going on with their strategy shifts, especially in behavioral.
And critically, look at those macro headwinds, the policy risks that investors really need to understand, sort of what's lurking beneath the surface.
Right. Let's get straight into it then. The result snapshot. On the face of it, just a massive beat. Q3 adjusted net income attributable to the company, $5.69 per diluted share.
Yeah, that's up 53% year over year. Huge number.
Huge. And total revenue growth keeping pace too, right? 13.4% year over year. Very strong.
It looks fantastic, definitely. But you really need to understand the why. The main thing driving that massive EPS number was a $90 million net benefit. And that came from a new supplemental Medicaid program in D.C.
Okay, $90 million, that's significant. But you said new program. Is this ongoing revenue?
Well, here's the kicker. It's actually retroactive. That $90 million covers the whole 12 months ending September 30, 2025.
Okay, so it's like a one-time catch-up payment hitting the quarter.
Pretty much, yeah. It reflects the ongoing program value, but the cash hitting this quarter makes the year-over-year comp look, extraordinary.
Got it. So less of a pure operational surge, more of a funding mechanism timing benefit.
That's a good way to put it. Now, don't get me wrong, the core business was strong. We'll get into that. But the magnitude of the beat, that was fundamentally shaped by these funds.
And management seems confident it's sticking around, right? They raised guidance.
They did. They bumped the midpoint for 2025, adjusted EPS guidance up by about 6%, took it from $20.50 to $21.80.
Okay.
So they clearly believe these supplemental payments are, part of the new baseline going forward. But it's crucial to remember where that uplift came from.
Right, important context. Okay, let's peel back the layers then. Core operations, starting with acute care, same facility basis. How did that look once you strip out the D.C. money?
Yeah, acute care looks pretty healthy, actually. Adjusted admissions, their main volume measure, that was up a solid 2.0%.
Okay, decent volume. What about pricing and efficiency?
That's where it gets interesting. Net revenue per adjusted admission saw a really strong increase, 7.3%, and that's after excluding the D.C. benefit.
Wow, 7.3%. That suggests good pricing power, maybe favorable case mix too.
Exactly, and they paired that with some impressive cost control.
The other side of the coin. How did expenses look?
Operating expenses per adjusted admission, they only increased by 4.0%.
Okay, so revenue per admission up 7.3%, cost per admission up only 4.0%. That's great leverage.
That's the magic formula, right? That gap drove some serious margin expansion. Same facility EBIT margin expanded by 190 basis points to 15.8%, again, excluding the DC impact.
Nice. And any update on surgical volumes? That was a bit soft earlier in the year, wasn't it?
It was, but they saw an improvement this quarter. Surgical volumes were actually up slightly. Management sounded pretty positive that this signals things are kind of normalizing.
So the catch-up effect from COVID-deferred procedures might finally be washing out.
That seems to be their read on it, yeah. Moving past those skewed comparisons from last year.
Okay, solid performance in acute care then. Let's shift to behavioral health. This has been, well, let's call it the challenging segment, mainly due to staffing, right?
Yeah, the problem child, maybe. Labor is definitely still the story there.
So what did the numbers show in Q3? Did they manage to break through those staffing constraints?
Well, revenue looked good on the surface, up 8.5% on a same facility basis, excluding the DC benefit.
Okay, 8.5% revenue growth sounds great.
The volumetric adjusted patient days was only up 1.3%.
Only 1.3%. So revenue growth is mostly price mix, not more patients.
Precisely. And 1.3% volume growth, while it's a little better than Q2, it's still pretty muted. It underscores that staffing remains the bottleneck.
Where is the bottleneck hitting hardest? Is it specific roles?
Management was pretty clear. They said volumes are still being held back in about a quarter, maybe even up to a third of their facilities. And it's the usual suspects: nurses, therapists, technicians. Just hard to find and keep people.
So they acknowledge the slow progress on volume. What's their long-term target there?
They do acknowledge it, yeah. But they're sticking to their guns, saying the reasonable long-term goal for adjusted patient day growth should be in the 2% to 3% range.
Okay, so they believe the demand is definitely there if they could just staff the beds.
That seems to be the implication. Demand isn't the issue. Capacity constrained by labor is.
Which makes their big strategic move interesting. pivoting towards outpatient behavioral. Tell us about that.
Yeah, this feels like a significant shift. They're moving away from just focusing on inpatient beds. The plan is to capture more outpatient volume.
And they mentioned outpatient is growing nationally.
That's what they're seeing, yeah. So they're launching these step-in programs.
Under a new brand, right? Thousand Branches Wellness.
That's the one. And the key here is capital efficiency. They're saying these clinics only cost about $1 million to $2 million each to set up.
Much cheaper than building a new inpatient wing, I imagine.
Yeah.
What exactly is a step-in program?
Think of them as highly localized outpatient centers, maybe partial hospitalization programs. They're designed for patients who need pretty intensive support, but don't necessarily need 24/7 inpatient care.
Okay, so bridging the gap.
Exactly. And it's less risky, lower capital, lets them test markets faster. They're opening 10 this year.
So is this partly a workaround for the staffing issue, needing fewer specialized inpatient staff?
I think that's definitely part of the calculus. It lets them address the high demand for behavioral services in a way that's less constrained by the specific labor shortages hitting inpatient facilities. Pragmatic.
Makes sense. Okay, switching back to the traditional growth model, new hospitals. How's the West Henderson Hospital in Nevada doing? That was a big project.
West Henderson seems to be a real success story so far. It actually hit positive EBITDA pretty much right after opening.
Wow, that's a quick ramp up. Any downsides?
Just the expected cannibalization. It's pulling some volume from their existing hospitals in that market, about a 50 to 60 basis point hit to same-store adjusted admissions. But, that's often the price of expanding in your own territory.
Understood. And the other big one, the turnaround project.
Yeah.
Cedar Hill Regional Medical Center in D.C. That's been a major financial drag.
It has been, yeah. Very expensive. But the news there is actually quite positive.
Oh.
How so? It lost $25 million in Q3, which sounds bad.
Yeah, still a big loss.
But management expects it to exit Q4 at break even or maybe even slightly better.
Really? Break even by year end? That's faster than expected, isn't it?
It seems like it, yeah. And the key thing for investors looking ahead, that total $50 million loss they expect for all of 2025, that flips entirely. It should become a significant positive tailwind in 2026.
Okay, that is a big deal for next year's comparisons and overall profitability.
Huge swing factor.
All right, let's zoom out again. Investor context, risks, guidance details, and capital allocation. Let's revisit that guidance raise. You mentioned the source matters.
Absolutely, because it tells you about the quality and sustainability of the earnings beat and raise.
So break down that roughly $95 million midpoint guidance increase again. Where did it actually come from?
Okay, it's pretty straightforward. You start with $140 million in increased benefit from state-directed payment programs, mostly that D.C. Medicaid money we discussed.
Right, the big external factor.
Then you subtract offsets, about $35 million for a higher accrual for malpractice reserves.
Like an internal risk adjustment.
And another $18 million for a legal settlement. So $140 million in, minus $35 million, minus $18 million. That nets out to that low to mid $90 million increase in the guidance midpoint.
Got it. So 100% of the guidance increase came from policy and program funds, net of some internal costs.
Yeah.
The core operating strength supported the base, but the raise was external.
Precisely. It's a critical distinction. And it leads us right into the risks, because these state programs can be volatile.
Let's talk about those longer-term policy risks then. The big one seems to be this OB3 legislation impacting Medicaid supplemental payments. What exactly is that?
Yeah, OB3. It's basically federal rule changes aimed at, let's say, tightening the screws on how states run these supplemental payment programs like the DPPs. The feds want more scrutiny on how the money flows.
And these programs are crucial for hospital finances, right?
Absolutely critical, especially for operators with significant Medicaid exposure. So any tightening of the rules is a potential headwind.
How big a headwind are we talking about from OB3?
Management put some pretty sobering numbers out there. They estimate that starting around fiscal 2028, these OB3 changes could ultimately reduce the aggregate net benefit they get from all these supplemental programs by $420 million to $470 million.
Wow. Cumulatively by 2032.
Cumulatively by 2032, yeah. That's a massive potential impact baked into the long-term outlook. Creates a lot of uncertainty.
Definitely a cloud on the horizon. What about the other risk mentioned, the exchange subsidy cliff, patients on ACA marketplace plans?
Right. So about 6% to 6.5% of their acute admissions come from patients on these exchange plans. Think states like Texas, Florida, where they have a big presence.
And the risk is that the federal subsidies helping people afford those plans might expire.
Exactly. If Congress doesn't renew those enhanced subsidies, affordability drops, potentially leading to more uninsured patients or bad debt.
What's the potential financial hit?
Management quantified it as a potential $50 million to $100 million negative impact per year. And interestingly, they noted that because they're seeing rising exchange volumes right now, that impact is probably trending towards the higher end of that range, closer to $100 million.
Okay, another significant policy-driven risk to watch.
Definitely a political risk translating directly to potential margin pressure.
Yet, despite these future clouds, their immediate reaction, especially on capital allocation, seems, well, very confident, aggressive even.
Oh, absolutely. The message on capital return is loud and clear. The board just authorized a new $1.5 billion increase to the share repurchase program.
Wow, another $1.5 billion. What does that bring the total authorization to?
Brings the total remaining firepower to just under $1.76 billion. It's a huge amount.
And they actually use these authorizations, right? It's not just window dressing.
History says they do. Since 2019, they've bought back something like 36% of their outstanding shares. They are serious about shrinking the share count.
That's incredible. Basically manufacturing EPS growth, even if organic growth is just okay.
That's a big part of the strategy. And management was explicit. Unless a really compelling M&A deal comes along, the priority is share buybacks and dividends. They pointed to their low leverage as giving them room to do this.
So they view their own stock as the best investment right now.
Seems that way, yes. Very strong signal.
Okay, that leads us perfectly into our next segment.
Yes. Let me just say first, this part of the discussion is purely for entertainment and illustrative purposes. It explores plausible market reactions based on the call. This is absolutely not financial advice. Please don't go out and make trades based on this. Consult a professional.
Duly noted. Very important disclaimer. Okay, with that cleared, let's brainstorm a plausible, maybe even a bit high leverage trade idea based only on what we heard on the call.
All right, well, you've got this clear commitment to capital return, the low leverage. It kind of sets a floor, doesn't it? The buybacks alone provide significant EPS growth.
Right, so a simple long position seems supported by that buyback yield. But how do you add leverage or make it more interesting?
You could structure it as a relative value trade, go long this stock, but hedge or finance it partly by shorting a peer company.
Interesting. Why short a peer? Based on what from the call?
Management actually gave a little hint themselves. They contrasted their own, maybe more measured growth strategy against competitors who they said were aggressive and are now having to temper that and go backwards, maybe closing facilities.
So you're betting on the disciplined operator versus the one potentially overextending.
Exactly. You're betting that this company's focus on returns and balance sheet strength will outperform peers who might be facing tougher choices now. It's a bet on capital allocation discipline.
A slow and steady paired trade, essentially. Okay, what are the near-term catalysts that could make this specific long position work even better, say, next couple of quarters?
Two things jump out immediately from the call. First, that Cedar Hill turnaround. If they hit break even or better in Q4 like they guided, that removes a major drag and becomes a big positive swing factor for 2026 earnings. That's a near-term catalyst.
Okay, the Cedar Hill flip. What's the second one?
The second is management's own signaling about leverage. They mentioned they might consider increasing their leverage ratio from its current low levels.
To potentially fuel even more buybacks.
Precisely. If they decide they're comfortable carrying a bit more debt to accelerate that $1.76 billion buyback authorization, or even expand it further, well, that could unleash a torrent of capital return.
And that's non-operational EPS growth that maybe the market isn't fully pricing in yet.
Could be. It adds another potential lever for upside beyond just the core business performance.
Okay, fascinating potential dynamics there. Let's try and wrap this up then. Key takeaways from this Q3 deep dive. Obviously, the huge adjusted EPS beat stands out, but we know now it was heavily driven by that retroactive D.C. Medicaid funding.
Right. Operationally, acute care showed really strong margin expansion through good pricing and cost control.
And the big turnaround story at Cedar Hill looks like it's finally turning the corner, set to become a tailwind next year instead of a drag.
And perhaps the clearest message, that massive commitment to capital return via the new $1.5 billion buyback authorization.
Definitely a strong signal. But what's the lingering question for investors, the thing to really watch going forward?
For me, it comes back to behavioral health. Specifically, can this new outpatient strategy, the 1,000 branches wellness clinics, can it actually overcome those persistent staffing challenges that have capped inpatient volume?
And can it translate that reported national demand for outpatient services into hitting their own 2% to 3% volume growth target for the segment overall in 2026?
Exactly. That's the key, I think. Will this strategic pivot really re-accelerate growth in the behavioral segment beyond just these, helpful but potentially volatile policy tailwinds. That's what will likely determine the long-term trajectory.
A crucial question indeed. Something for all of you tracking the space to keep a close eye on. Well, that brings us to the end of this deep dive. Thanks for joining us. And just one final reminder, everything discussed today was for informational and entertainment purposes only. It is not financial advice.
Thanks for listening.